What's a payout penalty? This is often not a problem when people first get a loan or a mortgage. This tends to be a problem when they want to go and pay it out. And so a payout penalty is an amount of interest and or a fee that's charged by a bank or lender for a borrower who pays their mortgage or loan out before the term is over. So as an example, you agree to borrow money on a 5-year term. And then in the 4th year, you either sell the property, or if it's a business loan, maybe you come into some money and you want to repay the principal amount. The lender is going to say, no problem, we'll take your money, but we're going to charge you a penalty for doing that. This is because you are repaying the mortgage or the loan before the term is over, and the bank needs to ensure that they've gotten all the money that they can. So there's two basic kinds of payout penalties. There's something called an interest rate differential. You'll often hear the shorthand of IRD, interest rate differential. And then there's a specified amount that they'll charge you, and that could be say 3 months interest or $60,000 worth of interest before you can pay it out. The interest rate differential tends to be the one that most people get tripped up on, and the simple example would be, let's say you borrow money at 4% and then you want to go and repay the bank, you want to give them back their money, but interest rates have dropped from 4% to 3%. So there's a 1% difference there now. The bank basically says, look, if you gave us back our money before the term was over, well, we're not going to earn 4% on it anymore. Now we have to go and give it to somebody else at 3%. So instead of making that our problem, we're going to make that your problem, and we're going to charge you an interest rate differential. So we're basically going to charge you the amount of interest we would have earned on that money had you not repaid us at the full amount. So interest rate differentials tend to only be a problem when interest rates are dropping and people are looking to refinance or pay out their mortgages or loans early. Generally what we see though in the last couple of years is something more like just a specified amount. So a bank will say, yep, you can pay us out, but we're going to charge you 3 months interest. Or if it's a commercial mortgage or a business loan, the prepayment, or rather the payout penalty might sound something like, you can pay us out at any time after 90 days, or $60,000 or some interest amount. So just a quick recap, the way banks make money, you and me put money in the bank, they pay us next to nothing, then they turn around and lend it out to the marketplace. And the difference between what they pay us and what they collect from a borrower is kind of their profit. Now, obviously, it's a little bit more complicated and sophisticated than that, but that's kind of what's happening. So the reason they charge you a payout penalty is because they only make money if the money is out in the hands of borrowers earning interest. And so when you give it back to them, now they've got to find a new place to put that money. And so the penalty is meant to compensate a bank or lender for all of the work that goes into having to kind of redeploy their money again. Banks and lenders need to keep their money working, so payout penalties help banks and lenders make up for lost time. That a payout penalty typically gets charged when someone is repaying a mortgage or loan before the term is over. So make sure that if you are in a situation where you're going to be repaying a mortgage or a loan, that you're very much aware of what the payout penalty is going to be.